Hello and welcome back to another episode. Today we were looking at some of the potential effects that FOMC meetings may be having on gold prices. Before we begin, please take a moment to like and subscribe to support the channel. Thank you. Over the course of the last year, we've released several videos providing updates on the Fed, how they're setting interest rates, and how that in turn affects the price of gold. But what we haven't done yet is look at the FOMC meetings themselves and question what immediate impact those meetings are having. With institutional investors watching the Fed closely to determine portfolio allocations, there is an important question to answer. Do the FOMC meetings themselves become pivot points for large investors whose decisions, based on the FOMC meeting, affect the prices of gold and perhaps silver? There is an enormous body of scientific literature dedicated to studying the macroeconomic impact of FOMC meetings, so there is a rational basis for the question. Let's review the data. At the time of preparing this video in early October, we've had 6 FOMC meetings that we can review for the year. In 5 out of 6 of those meetings, the spot price of gold has declined within 2 weeks of the meeting. Keep in mind that this is empirical data. We think there's a compelling narrative that makes a lot of sense. At nearly all FOMC meetings, the following press conference included hawkish remarks. March was an unusual month given that Silicon Valley Bank failed on March 10th, sparking a massive wave of gold buying that drove the spot price of gold up. It was the largest surge in demand for gold bullion we've ever seen, and investor sentiment at the time was a mix of fear and also hope that interest rates would decline. The news was filled with pundits, analysts, CEOs, and talking heads all saying the Fed was going to cease rate hikes and maybe even cut rates because they had broken the banking system. That obviously did not happen. And while Powell did address the bank runs immediately in his speech on March 22nd, the bottom line is that rates were paused instead of cut, and they continued to communicate a balanced and somewhat hawkish tone on interest rates. The March FOMC meeting is the only one in which a hawkish tone was conveyed, and spot gold prices continued to increase. For our purposes, we're considering Powell reiterating their commitment to quashing inflation using all tools available at the March press conference as a hawkish tone. The September FOMC meeting on 9/20 was the most impactful, with a minus 6.4% decline in spot gold prices. If you'll look closely, you'll see the September 20th FOMC meeting on this chart, and almost immediately following the meeting, we see a sell-off. 2 weeks later, the spot price of gold had declined by over 6%, measuring from September 20th to October 4th. If you look at other dates, we see a similar, though less severe and pronounced retraction when looking at the July, June, May, and February meetings. The most striking thing about this is how immediately gold prices seem to decline following an FOMC meeting. Now, one compelling theory is that the target Fed funds rate is a primary information piece that investors use to adjust their portfolios. The Fed releases committee assessments on the Fed funds rate once per quarter, in March, June, and September this year so far, and December of last year. The participants' assessments have become progressively worse for the spot price of gold, which suffers under high interest rates environments. While March is an outlier to the other FOMC meetings, there is perhaps an additional reason for investor confidence beyond the misplaced belief that interest rates would soon be easing. The Fed Funds Target Range survey released in December 2022 was virtually identical to the one released in March. To help you understand this chart, you can see on the right-hand side where the y-axis sits, we have a range of 0 to 6% target interest rates. The dots represent where committee members think the midpoint of the target range of the Fed funds rate should be for a particular year. You can see the year in the x-axis along the bottom. So in March, most committee members seem to feel that 2023 should be a little over 5%. with half of the members suggesting rates ease down to 4.5% or lower in 2024. Following that into 2025, most seem to believe rates adjusting down below 3.5% would be appropriate, leading down to 2.5% in 2026 and beyond. So this was promising because it was the same message that we received in December. Well, let's look at June's chart. June got a little worse. A couple of changes to the chart should be noted, where the y-axis went from a maximum of 6% up to 7%. For 2023, most members felt that rates should adjust upward over 5.5%. In March, most members thought the midpoint should be below 5.25%. The numbers for 2024 also adjust upwards, as did 2025. The lengthening of the chart for 2025 does offer a somewhat more optimistic viewpoint than rates for 23 and 24, because it indicates that there is a wide range of opinions on what rates for 2025 should look like. And again, 2026 in the longer run hadn't really changed. Mostly opinions were consolidated around the idea that interest rates should stay around 2.5%. Overall, a restrictive monetary policy and a worse outlook for assets like gold, but not catastrophic. On September 20th, things were a little different and a little worse yet again. Now, September is a bit of a shock for a few reasons. The first being that this is a great visual representation of what higher for longer looks like. This is the first time we've seen 2026 added to the roadmap for elevated interest rates, with half of the committee members in favor of rates between 3.5% and 5%. That's huge. Well, now there is a whole story to be told in that area alone. I want to draw your eyes back to the year 2024. Now, recall, if you will, that in March, half of respondents thought interest rates should drop below 4.5% in 2024. Now, virtually the entire group thinks rates should be higher than that. So if interest rates ease at all in 2024, it looks like it would only ease by a very small amount. And that's assuming the Fed doesn't decide to simply hold their position on rates. And possibly a concerning change is to the longer run column. Remember, the Fed has been transmitting their belief that 2.5% is a consensus target for the time beyond this restrictive monetary policy phase, and we still see a lot of consolidation in that target range. But a few participants adjusted their targets upwards. We're now seeing participants suggesting that a long-term interest rate policy between 3% and 4% could be normal. The evidence seems to bear out from empirical observations that when the Fed broadcasts a change in policy that is more restrictive, investors take note and adjust their portfolios. This may result in outflows from gold to other assets. Under a high interest rate environment, treasury bonds that yield 5% or more can be an attractive investment option when compared to assets without a yield, like precious metals. This isn't definitive proof, and it does not provide us with anything approaching a statistical model, but it does give us some logical reasoning as to why prices may be moving the way they are. And crucially, if this narrative bears out, it shows that there is potential downside to gold prices yet to come. If so, we'll be looking forward to a future buying opportunity to stack more ounces of gold at lower rates. Interestingly enough, pundits and analysts still seem quite bullish on future gold prices heading into 2024. Perhaps they are seeing the price strength and persistent demand for bullion in 2023 in a high interest rate environment as proof that when rate cuts do finally occur, the upside to gold should be equally strong. Or perhaps they're focused on other myriad factors that impact spot prices. Leave us a comment down below and let us know what you think. Are the FOMC meetings having a large impact on gold prices, or is it a combination of factors? Do you think gold is headed lower or higher going into 2024? And if it does go higher, are you less likely or more likely to buy? That's all we have for you today. Thanks for watching, and we'll see you next time.